Good morning, everyone. Thank you so much again for having myself and my colleague, Mac, from 501c Services here with all of you today in New York City. It looks like it's another beautiful day. I wanted to start again very briefly introducing myself as well as 501. Again, my name is Ben. I've been an insurance professional servicing 501c3 nonprofits across the country for the last decade now. My experience began in underwriting, as a matter of fact, with a nonprofit insurance company out of California called NIAC. Here in New York, they do business as Annie, and some of the nonprofits in this room may be a part of their program. From Nonprofits Insurance Alliance Group, I moved on to sales, where I assisted nonprofits in my local community with securing property and casualty insurance for their operations. And it was in my work in sales that I was recruited by 501c3 Services. 501, as I mentioned, is a risk management firm in Silicon Valley, California. We're dead center in San Jose, right next to my alma mater of San Jose State University. And we've had a 30-year plus experience with assisting 501c3 nonprofits, as I mentioned earlier, with securing alternatives to paying the state unemployment insurance tax. We've, as I said, have been doing that for 30 years. We enjoy over 1,500 members as a part of our legacy program. And it's been in the last 2 or 3 years that we've worked alongside Great American Insurance Group to change the model of our business and deepen our offer. And while we won't talk specifically about what 501 does, we are going to talk today about some of the programs that are out there in the marketplace today with regards to unemployment and how might your organization or your clients might be able to implement them effectively. I want to turn our attention to our first slide and kind of run through the objective for today. In sales, the conversation is all about creating value, and that was my focus today. It was my hope to put a presentation together that everyone in the room could find some utility in, whether it's presenting something to your client that can improve upon their risk management, or it's something that you can bring back to your organization to improve upon your understanding of your own unemployment program, or potentially reduce your costs or make your life easier. But again, the through line here is providing knowledge and useful tips that can be used today either at your clients or at the nonprofits that you represent, and improving upon your risk management of unemployment. We're going to talk about trends in the marketplace. Again, this is all about unemployment. And when I'm talking about unemployment, I want to be clear, we're not talking about workers' compensation. I'm not talking about the state disability insurance that some of you may be familiar with. We're talking about the unemployment benefits that are meted out by the state to employees that are separated by their employers. So we're going to talk about, I beg your pardon, trends, strategy, tactics, and what's driving the marketplace today. I also want to talk specifically about how unemployment is impacted by mergers, acquisitions, and divestures. I think that's such an important component of the nonprofit community today. We see so much of that, where people are taking on partnerships, and unemployment is an important component that we need to be contemplating as a part of those mergers and acquisitions and when organizations find their way apart from one another. I'd also like to talk about how we can, or I beg your pardon, how all of you, either with your clients or at the organizations that you represent, assess your unemployment liability. And there's utility there. My hope is to provide everyone not only with the means of doing it, but to show you how you can use that information at your organization to plan for catastrophic risk or better improve how you're managing your unemployment exposure today. So we're going to dive right in. But it begins with sharing a lexicon. So what I have found in working with nonprofits across the country is that people are familiar with the alternatives available to them with regards to unemployment, but no one shares a language. So I thought I would start our presentation today with some an informal, interactive poll. I would like to know if either your clients or at the organizations that you're a part of, if you pay as you go your unemployment costs, if you're familiar with that, if you could raise your hand if you pay as you go your unemployment bill. Okay, a few. If you self-insure your unemployment, a part of this conversation also is going to be about how we can create or put insurance programs into place that mitigate against catastrophic insurance and protect the nonprofit in the worst case scenario. I know here in New York, there was a problem with a workers' comp risk pool for nonprofits that exploded and caused a lot of headaches. And so I was cognizant about some of those issues in putting this presentation together, and we're going to talk specifically about how folks in New York can do this the right way. The base period is going to be another important component of our conversation today. As a raise of hands, from an unemployment standpoint, does anybody know what the base period represents? If I were to talk about a base period or a base wage period, I got 1, 2. Okay, great. The base period, we're going to talk about that more in detail, but it has to do with the timeline of liability that we need to be mindful of, either during a merger or acquisition or just managing our unemployment costs specifically. And I have a chart later down on in the presentation that's going to show us what the base wage period is and how we can examine it. Finally, I want to differentiate may be the wrong word, but I want to clarify compensation and benefits. I know lots of organizations now have employees across the country, right? We're not just in New York State or just in one state, but we have got operations and impact across the East Coast and across the country. Because unemployment is managed at the state level, each state manages it a little bit differently, and they use a different language. Some states, you'll hear them say compensation. They'll refer to UC, unemployment compensation. We see that in Pennsylvania and New Jersey quite a bit. Other states will refer to it as insurance. They'll talk about their unemployment insurance program. And yet other states will refer to unemployment benefits. But fundamentally, they're all talking about the same thing, which is those payouts that are going out on a weekly basis to employees that have been separated from their employers. And those costs, of course, have been financed in one way or the other, and we'll explore that also. Let's talk about some trends that we're seeing in unemployment specifically across the space, and I want to talk about New York specifically. I'd like to start with what's known as the taxable wage base. So here in the state of New York, over the next 10 years really, the taxable wage base is going to be increased pretty significantly. Today, the taxable wage base, and that is the portion of every individual employee's wage that is eligible to be taxed to the employer to finance the cost of unemployment benefits, right? So here in the state of New York today, the first $11,100 of every individual employee's wage is eligible to be taxed by the state of New York for these unemployment benefits. By 2026, we're going to see that those numbers elevate to $13,000. And that trend is important to be mindful of because it's going to increase the costs of those that are participating in the state unemployment insurance tax. As the taxable wage base increases, right, as more money of each person's wage is eligible to be taxed, right, those organizations are going to see higher costs. So we want to be mindful of this proactively so that when those bills start increasing, assuming you're participating in your state unemployment insurance tax, you're not caught off guard. This trend also gives you insight into potentially proactively leaving the state unemployment insurance tax. We'll talk about what that looks like so that you are avoiding some of these increased costs, which I think is so important. Tax rates are another part of this trend. Here in the state of New York, the unemployment tax, not the tax rate, just the unemployment rate, it mirrors that of the nation at about 4.3%. As I'm sure everyone in the room is aware, we're enjoying an incredible economy right now, and as a result, unemployment is very low, and the tax rates across the country are very low. I don't know that that will be permanent. We'll see what the future holds. But for a lot of organizations that are participating in the tax today, especially those of you that have, say, less than $3 million in gross annual payroll, I think you're in the right place. Minimum and maximum tax rates here in the state of New York have also changed. The minimum rate is 0.9%. The maximum tax rate is 8.3%. We're going to look at some equations down the road of where that factors in. Those tax rates, as I'm sure you are aware, are what we're applying against your state unemployment insurance taxable payroll to get your tax liability. And as I said, we're going to look at some specific examples also. Another trend we're seeing is in the form of large reserves. So this has to do with those folks that are reimbursable employers, that are self-insuring their unemployment. I get a lot of phone calls from across the country, from nonprofit organizations, from CPAs, accountants, as even attorneys who want to find an alternative to the large sum of money that their client or that their organization has in reserve to pay for unemployment expenses. And I'll give you a brief example. We had a community action partnership in California that reached out, and they had $500,000 locked up into a Charles Schwab account with the intent of reserving those funds, as I said, to pay for unemployment benefits in the case that they were, really above and beyond, their unemployment experience was above and beyond what they were expecting. Problem was they were looking for a way of taking that money off of out of the freezer, right, off of ice. They wanted that money for their budget. They wanted to increase their operations to provide for young adult education in their area. So we worked together to create a custom stop loss plan that provided them with an insurance policy that would pay for their unemployment claims above a threshold, and then they could take out that money, that $500,000 out of their Charles Schwab account, knowing that they could put it into their operation and demonstrate to the board that they have contemplated the catastrophic risk, right? And so this is something that we're seeing across the country, is that organizations who have been reimbursable employers for years find that they have increasing reserve funds in a bank account, perhaps with a grantor trust or an unemployment fund, and we'll talk about that as well. And they're looking for an alternative to free those funds up, and we're seeing that across the country. Strategies, tactics, drivers. So the strategy that I like to share with you, with the folks that I'm fortunate enough to be in front of, is one of maximizing your cash flow, right? This is specific to organizations that may be participating in the New York state tax today, right? So as I'll give you an example, and we'll look at some specific tax rate notices further on in the presentation so that everyone can get an idea of how they can perform this analysis themselves. But if your organization, say, is paying the state of New York $100,000 a year in the form of the state unemployment insurance tax, which would be wrapped up in your payroll taxes, but we can ascertain that the state, as an example, is paying, say, $25,000 or $30,000 on your behalf in the form of unemployment benefits, there is a $75,000 or $80,000 discrepancy there. And when I talk about maximizing cash flow, I'm talking about accessing or recouping that $75,000 or $80,000 that's being overpaid to whichever state in which you're operating. By opting out and becoming a reimbursable employer, we can get a hold of that money, put it into your budget, and improve upon how you're using your cash, right? When we're talking about a tax liability, especially payroll, oftentimes it's exiting the organization in one fell swoop at the start of a period, right? As a reimbursable employer, an important component to consider is that your bill is for your unemployment benefits exclusively. I want to say that again. Your unemployment benefits reflect your experience exclusively. You are not participating in a risk pool. And so by making that administrative change, not only are we getting that money back, but we're holding on to our money for longer, right? Maximizing our cash flow. Another important or I should say a tactic of maintaining that strategy of keeping a hold of our cash is contemplating the catastrophic potential for an unemployment loss. And I'd like to do a quick survey once again. Could I get a show of hands of folks who have thought about unemployment as a part of their catastrophic risk management program? Could I get a show of hands? No one? One person? Thank you so much. I really appreciate your candor. Thank you. That's consistent with my experience. When I talk to folks across the country about unemployment, invariably I get a blank stare. You should try talking about unemployment at a dinner party. It's a catastrophe. But fundamentally, it's so off the radar for nonprofits, right? No one is thinking about this, oftentimes because it's wrapped up in their payroll. And oftentimes what I hear is, this has never happened to me before, right? I don't know if anybody has a kid and they've told you that, maybe a teenager who's just started driving, I've never been in an accident before, right? That's no kind of logic, I always tell people. This may have not occurred to you before, but it is not an excuse for failing to consider it in the context of your risk management program. So what I would like for everyone to, whether it's bringing this up with your client or bringing this up at the board or with your executives is let's think about the big picture. Let's think about catastrophic risk. What will it look like if we lose a large grant? How are we going to contemplate that? How is it going to impact us from an unemployment standpoint? How are we going to pay that bill if we're a reimbursable employer, right? If we're self-insured? I'd like to chat another story I think that was compelling. I was working with, as a matter of fact, another community action partnership out of Hawaii, who it was wonderful because they proactively reached out and were concerned about this issue. A substantial portion of their money for their Head Start program was secured thanks to a federal grant. And I was working with the chief financial officer who had concerns about what would it look like if they didn't receive this federal grant, and what would their liability from an unemployment standpoint look like. Well, their total loss eclipsed over $3 million. If they didn't lose that grant, they were going to have to come up with $3 million for the state of Hawaii, and that was going to have to come after their budget. So we worked diligently to create an insurance program that protected them on high in case they had those unexpected losses. And this was something that CFO could bring to her brand new president of the board and demonstrate that the necessary steps were being taken to look at the entire picture, right? And she developed a great relationship as a result of this, and we were able to deliver. Finally, I want to talk about seeing opportunity. Specifically, I mentioned the high reserve piece, but another factor that's driving some of the choices that are being made is reputational risk. And I'm going to talk a little bit more about that further in the presentation, but I was really excited to hear Jim discuss it and bring it up here today, because who we work with is essential. And while price may be a driver, right, on the front end, just as Jim pointed out, when fraud happens, not only, there are two risk exposures that we're facing, first of which we're facing a substantial loss of money in the form of fraud, but there is the reputational risk, right? The impact that has on the image of the organization. It is essential, I think, that we look at that beyond issues of price and see the opportunity of working with a partner who offers us those protections. Mergers, acquisitions, and divestures. I'm seeing this more and more throughout the industry. Can I get a raise of hand? Are people seeing that all over the place as I am? Mergers and acquisitions, is that something that people have experience with? Great, excellent. So I want to walk through these 5 steps of how a nonprofit organization, either who is taking on a partnership in the form of a merger or is moving on from a relationship in the form of a divestiture, can take to better analyze their unemployment risk. And then I want to walk through some specific examples, or I should say specific instances that we've come up across in the state of New York that I think will be valuable for everyone as they look at mergers and acquisitions potentially in the future. Starting with number 1, fundamentally we want to identify who is the surviving entity, right? It's a fundamental question that we're all asking in mergers and acquisitions, regardless of unemployment. What is the structure of that relationship? Is this a subsidiary? Is this new partnership? Is this nonprofit organization just being assumed by a parent company and being taken on? But we want to understand that very well. Next, you want to identify how each entity, and this is especially important in the context of a merger, how each entity is managing their unemployment today. And by that I mean, how are they financing the cost of their unemployment? So if you're taking on a merger, you want to know if that nonprofit organization is a reimbursable employer. You want to know if that nonprofit organization is a taxpayer. Does that nonprofit have an insurance program in place for their unemployment? Do they work with a third-party administrator? Have they had layoffs in the past couple of years? What has their turnover looked like year to year? Those questions are essential during the process of a merger, because what you're doing is identifying the liability that you, as the organization that's acquiring this new company, may be responsible for. Tracking liability. Tracking liability is really building off of some of those questions that I just identified. We want to be sure that the organizations that's coming on, if they either were a reimbursable employer or were participating in the tax, have some knowledge of their unemployment experience year to year and can speak to it. Okay. At this point, I want to dive into some specific New York State issues that come up that we see pop up during mergers and acquisitions. And this is really about controlling your liability. Okay. So the first example I have here is if a taxpayer is acquired by a reimbursable employer, right? So in this example, we have a large nonprofit organization that is insuring, is self-insuring their unemployment experience on their own, and they're acquiring an organization that is participating in the state tax, perhaps New York state tax, East Coast, West Coast, what have you. The surviving reimbursable employer must, especially here in New York, has to understand that for the next 7 weeks, no, I beg your pardon. So that following the 6 months after the merger, that if any employee at the old organization, at the organization that was acquired, files for unemployment, right, goes to the unemployment office and says, my name's Ben, and I was working for nonprofit A, I was laid off and I'm filing for unemployment. The organization that is surviving is going to be responsible for 7 weeks of liability after the merger, leading up to 6 months. Okay, these kind of costs catch people by surprise. I get folks either talking to me about their clients or at their organization saying, I'm getting these bills. I'm getting these bills from folks that never worked at my organization, and I don't understand why this is due from me, and I'm not happy about it. Right? I'm really frustrated about it. I have a board that's frustrated about it, or my chief financial officer isn't happy about it. Can you explain this to me? What happened? Well, what happened was in the state of New York, leading 6 months after your merger, when someone files for unemployment, you're going to be responsible for the first 7 weeks of that claim. And here in the state of New York, the max claim could be $435 per week. So times 7, we're looking at about $3,200. If you've got 10, 20, or 30 people, that math adds up very quickly, right? And it can be real consternation for an organization who's taking on a partnership, right? And it can get in the way at times of that new relationship. Let's say as the opposite example, okay? Let's say you have a reimbursing entity that is acquired by a taxpayer. So I'm a big nonprofit. I participate in the New York State tax. I'm taking on a much smaller organization. Let's say, for example, that I'm assuming them into my operation. So it's going to be all me. I'm just taking on their operations and I'm going to be doing their work for them. Over the next 6 quarters, as the taxpayer, I'm going to be getting the bill from this reimbursable employer. So I'll say that again. For the next 6 quarters, for the next year and a half, I'm going to be getting the bill from the organization that I took on as a merger. Again, if these costs are popping up, if we're getting a bill from the State Department, that has a source to be incredible consternation and frustration for the organization. Why do I have to pay this bill? Where's the money going to come from to pay for this? Who's responsible for this? Why didn't we catch this? So if you are a tax-paying entity who's taking on a merger of a reimbursable employer, you are going to be responsible for that acquisition's unemployment experience for 6 quarters, okay, for a year and a half. The third example that I want to present here is that if we've got 2 self-insuring nonprofits that are coming together, okay, so we have 2 reimbursable employers that are coming together, in the form of a partnership. It's about billing management at that point, right? You're going to get the surviving entity is going to be getting 2 separate bills for those claims over 2 years, over a 2-year period. So that surviving entity is going to be responsible for the organization that died and its unemployment claims for the next 2 years, okay? These are long timelines, and I think that's why, to my mind, that's why I thought it was so important to share them. When we're talking about 2 years or 6 quarters, this stuff pops up way down the line. And then whether it's at accounting or at the executive level, people get, as I said, really frustrated. They get really angry. Why am I paying for Ben's unemployment claim when he filed for this claim in 2019, but he only worked for us in Q4 of 2017? right? Shouldn't be getting these claims. What's going on here? So the information here about that, how that liability extends out into the future, I hope will help everyone with their clients or at their organization be mindful of this going forward. One by one. So a lot of organizations are working with multiple, as I said, have multiple operations across the country, state to state. When we're taking on a merger or we're divesting an organization, I think there is the tendency to think there is a one-size-fits-all program, right? Here at Nonprofit A, we handle unemployment in this way, right? We're a taxpayer, we're a reimbursable employer, so all of our subsidiaries, all of our partners, they're gonna work with unemployment in the same way. I would argue that that is cost ineffective, because fundamentally, what I think we have to do is work on a one-on-one basis with each entity that is a part of our organization and independently ascertain what their unemployment experience is and determine what the best way to manage that organization or that subsidiary's unemployment on a one-off basis. And I'll give you a couple examples. I was working with a large nonprofit in California that provides legal services to underserved folks in rural communities. The majority of their operations take place in the Central Valley, but they've got employees in Wisconsin and in the Southwest as well. And I had showed up having a conversation with them about their unemployment, and they were of the opinion that because they were self-insuring, they were a reimbursable employer in California, that was the best thing to do in Wisconsin and in New Mexico. And we sat down and we looked at a couple things. The first thing I wanted to ask them was how much they're paying in taxes in Wisconsin and in New Mexico. And in Wisconsin, they were paying about $11,000 a year annually for their unemployment tax. And in New Mexico, it was just under $9,000. So they had a total annual liability of about $20,000 a year for their taxes. And they pointed out to me, it's like, if we opt out of that tax system in those two states, I could save my organizations $20,000. I was like, that's true. You know, if you had no claims and you weren't paying this tax at all, then you would save yourself $20,000. But we took a closer look at what the max claims look like in those two states. In New Mexico, a max claim runs just under $13,000. In Wisconsin, it's just under $12,000, and that's for one maximum claim. And so what I argued was that why would we risk the organization, right, having to pay maybe $40 or $50 or $60 or $80,000 if 5 or 6 people leave this organization just to save $20,000 on the short term, right? So a conservative approach, I think, demands a one-by-one analysis of your unemployment. And I would encourage all of you in this room, whether it's at your client again or at the organization that you're working at, to consider managing unemployment on a state-by-state basis, okay? You may see that opportunity where you're paying $8,000 or $9,000 in a state where you've got 3 or 4 or 5 employees, and that $9,000 may look sweet, but I think you need to measure it against what your potential liability might be if you've got 5 or 6 people leaving, right? It's gonna be a hard conversation to say, we saved $8,000, but now it's costing me 75, right? Out of my budget, we're shutting down programs, it's a problem. State requirements. So as we're taking on mergers, we're taking on new people out of state, we want to be mindful of the individual specific state requirements that are put on nonprofits who want to become reimbursable employers specifically. Those typically are in the forms of collateral, whether they be in surety bonds or cash deposits held with the bank. These are important characteristics that you want to identify in the course of the merger prior to making any kind of final decision. If you're going to have to post a bond, we're going to want to know what that costs. If it's a cash deposit like it is in North Carolina or Hawaii, states that require the nonprofit to keep money with them, with the state itself, for the purposes of reserving, we're going to want to be mindful of those costs moving forward. Assessing your unemployment liability. 4 fundamental variables that I'd like us to take a look at today. We don't use each one of these variables in all of our in every equation of assessing a liability, but this is fundamentally what we want to be looking at. First of all, we want to be contemplating payroll. Okay, either your gross payroll at the organizational level or your SUI payroll. SUI is an acronym for your state unemployment insurance payroll, right? That is the portion of your gross payroll that is eligible to be taxed. We're going to talk about what it might look like to go back to the tax system. Reimbursable employer might be getting a hard deal, or they might see in the future that they're going to have to be laying off people in the next couple of years. And a proactive assessment of your liability may reveal that moving back to the tax system is going to benefit the organization. And we'll talk about how we can do that. Understanding or being able to calculate your SUI payroll is an essential component of making that analysis. The base period liability. This fundamentally is what kind of liability exists out in the past for us, right? What folks have worked for us over the last 6 quarters, how much have they gotten paid, how many of them are there? We want to be mindful of those numbers as a part of, as we look at contemplating or assessing our liability from an unemployment standpoint. For organizations that are looking to move back to the tax system, we want to know what the new employer tax rate is going to be. Here in the state of New York, it's 3.5%. So if for the last 3 or 4 or 5 years I've been a reimbursable employer, but I make the decision because, say, my organization has been shrinking substantially, that I want to make a move back to the tax, I'm going to need to have that. I'm going to need to know that 3.5% if I'm going to multiply it by my state unemployment insurance payroll to get an idea of what I'm going to be paying in taxes in the future. Okay. Finally, in assessing our liability, we need to get an idea of what our max benefit payouts might be, right? So in our state, we need to know what the weekly max is, the max duration of 26 weeks. Depending on the organization, we need to know the full number of employees or those eligible to file, right? Understanding the base period. So I spoke a little bit about the base period earlier, and I wanted to give a visual of how we calculate or of how we assess whether or not someone is going to be eligible for claims depending on when they work for us, okay? And I get questions about this issue all day, every day, and they're mostly angry, okay? Because people are not privy to how the unemployment system works, and they discover, again, that say, Ben filed a claim in 2019, right? And we nonprofit, he worked for us in Q4 of 2017, and we, the nonprofit, are getting hit with a bill for the period of time for that 1 quarter that Ben worked for us. And the bill that we're getting is called a base wage claim. Let me say that again. So I file a claim in Q1 of 2019. The state of New York is going to look at these 4 quarters, which is known as the base period. The first 4 of the last 5 quarters. They're going to look at where Ben worked during that period. Where did Ben work during that period? How much did he make? What was the situation of his separation? So here in New York, they assign unemployment proportionally, and they do this across the country as well. So if Ben was working at nonprofit just for 1 quarter in 2017, even though he's filing a claim seemingly 2 years later, that nonprofit may be hit with a bill, right? And we want to be aware of this going forward, one, so that when we get these bills, again, we're not just shocked, like, Ben never worked for me, I don't understand what's going on, right? A lot of confusion. And 2, we can look back in time to ascertain who was working for us, how many, what their wage was, to get an idea of what our liability might be. Here in New York, there's an important factor to consider, and that is for-profit employers, right? For-profit employers are afforded the legal right to challenge base wage claims. I'll give you an example. Let's say I left the organization here in Q4 of 2017, but my separation, I was fired for cause, and it was gross misconduct of some form of another. And after I was fired from the nonprofit, I got a job at Home Depot, right, in the next quarter. And I worked at Home Depot for a couple months, and I was laid off from Home Depot. And I went to the unemployment office. Now, my name's Ben. I was laid off from Home Depot, provide the information, and the state of New York looks back and says, okay, I see you were working for Home Depot for this time, but I see that you were working for nonprofit X during this quarter. So we're going to charge nonprofit X proportionally for the time that you worked there, Ben, and we're going to charge Home Depot proportionally for the time that you worked there. Now, a for-profit employer could come back to the state and said, Ben was fired from my organization for gross misconduct, right? A for-profit organization could challenge that claim and say, Ben worked for my company, he was fired for gross misconduct. I want a relief of those charges. I should not have to pay that bill. The nonprofit sector is not afforded that right. I want to say that again. Our sector is not afforded that right that the for-profit sector would, even though I know it doesn't make any sense. And even if it's gross misconduct, and I find this a lot at education, youth services, a lot of folks say, hey, this person was fired for something really egregious. I have a real serious problem with having to pay this bill. There's got to be something that you can do for me. And there isn't. It's just as a result of being a self-insurer, you have to own your base wage period. You have to own those claims regardless of the separation type. And I think it's so important that we all understand that going forward. So even when it doesn't seem fair, we're privy to why some of these decisions are being made. So I want to give a couple equations here. I'm checking my watch. I really want to be sure that we don't run into lunch. I know we're right there. As we assess our liability, I've got three things that I want us to consider here. Okay, the first of which is coming up with your SUI payroll. That is coming up with a portion of your payroll that's going to be eligible to be taxed by the state. Why is this valuable? Let's say you're at a nonprofit organization of one of your clients is, $3 million in gross payroll or less, and they see in the next 3 years or so that their operations are going to have to change or shrink substantially. Perhaps they're losing some private funding. Perhaps their services are no longer needed in their community. Another instance that is causing them to shrink. I think that organization would benefit from looking at going back to the tax system. And in order to do that, we need to know what your SUI payroll is going to be. And we get there by multiplying the total number of full-time and part-time employees you have by the taxable wage base in your state. As you know, here in New York, it's $11,100. We would multiply 11,100 by the total number of full-time or part-time employees. And that's going to give us an approximation of the payroll that could be taxed by the state of New York, right? If we were to take that payroll and multiply it by the new employer rate of 3.5%, we're going to get an idea of what your tax liability will be as a taxpayer, of course, right? And we want to measure that liability against what your unemployment claims might be as a result of your shrinking operations in this example, right? And it is the balancing of those two numbers, I think, that can give us an idea of whether or not being back in the tax system is the right fit for the organization. Finally, the third piece here is identifying the total potential unemployment liability that your organization might have to pay. For those that were kind enough to raise their hand as self-insurance folks or pay-as-you-go, the reimbursable employers, I think this is a must. I think it's essential that we're aware of what our total potential liability is out there. So one, we can plan for it and that we're not caught off guard. And we get there by taking the total number of employees that could file. We multiply that by the weekly benefit amount and we multiply that by the number of weeks. And that's going to give you your total unemployment. I beg your pardon, your total unemployment liability. Okay, so we can use that number to say, I know that my costs are going to be, if I take a total loss here, I'm going to be due $2.5 million. How am I going to pay for that? Where's the money going to come from? Is it going to come out of my budget? One of the things that Jim mentioned earlier, which is a key risk management point, was that the members, the members of the board should not be personally exposed to loss as a result of their participation on the board. Unfortunately, being a reimbursable employer exposes the members of the board and the officers to the potential for personal loss if the nonprofit organization is unable to pay its bill. Okay, I want to say that again. The members of the board may be personally liable should the nonprofit organization be incapable of meeting its bill to the state for unemployment benefits. Keep in mind that if you make an administrative change, you become a reimbursable employer, it does not mean that you are no longer paying a tax. The bill that you get is still a tax, and failure to pay it means that you have failed in your tax responsibility to the state. There was an organization in California that provided domestic violence services throughout the Bay Area. They have an incredible impact for a much needed group of women. And the executive director reached out to our organization a couple months ago up in arms. And the state of California had placed liens against her personally because the nonprofit organization had failed to pay their unemployment bill. And it was a very tough conversation because she kept asking me, well, what can I do? What can I do about it? And the only answer I had was, well, you have to pay the bill. Like, you have to give them the money now. And I want to share that message with all of you. We've got to have the money in place as reimbursable employers or as self-insurers. And failure to do so, again, exposes the members of the board to personal loss. It undermines our trust within the sector. Securing an insurance component or a custom stop loss policy can be a great effective way of demonstrating to your board or your client that we're thinking about the larger picture and that they're going to be taken care of in the long run. So that brings me to taking a look at moving back to the tax, and I want to identify 4 points that I think that we need to take a look at. One, obviously, what's the economy doing? Right? When the economy is tanking and going down, unemployment typically goes up, and as more unemployment benefits typically get paid out of the risk pool, we see an increase in tax rates, we see an increase in taxable wages, which is an increase in costs, right? If your nonprofit organization, as an example, will weather the storm effectively and you don't see a major downturn in your operations or loss of personnel as a result, being a reimbursable employer can be a great way of getting out of the storm, okay? Conversely, if you see your organization, as I said earlier, shrinking, changing its operation, losing out on folks in the future, it may be beneficial for management to take a look at what going back to the state unemployment insurance tax really looks like. You want to get an idea of your costs from a tax liability standpoint versus the cost of benefits, right? That's what we're trying to measure, determine whether or not it's going to make sense for the long term. And we want to think about how you're going to fund this, the structure of your organization, and the size of it as well. Typically, organizations with less than $2 million in gross annual payroll, I do not recommend become reimbursable employers. I think they're taking on too much risk. Typically, at those organizations, we're seeing somewhere between 15 and 25 full-time employees. They may be able to save 10 or 12, maybe $15,000 on their tax bill, but I don't think it's worth it if they're exposing themselves to as much as $100,000 or $150,000 loss, depending on their experience. You want to calculate your potential tax liability, right? Very simple. We're looking at our payroll multiplied by the new tax rate of 3.5%. That's going to give us an idea of what our costs are. I want to be sure that we're not running over because we're like 5 minutes away from lunch. I want to walk through 3 tax rate notices here in the state of New York, the state of Maryland, the state of Pennsylvania. As I saw, the majority of folks looked like they were participating in the tax, or at least they weren't sure that they were self-insurance. So I want to give everyone a kind of technical background on how they can look at these tax rate notices, either with your client or at your organization, and ascertain what your status is today. Okay, the first thing that we want to do is identify our tax rate, right? Here up at the top. This is from the state of New York. I beg your pardon. So this is going out to all employers here in the state of New York. Up at the top here, we start with our tax rate. In order to get an accurate tax rate, you're adding these 2 numbers together, okay? I'm sorry. You're adding the subsidiary rate and the unemployment insurance to get a total, in this case, of 2%, and you would multiply that by your, as you can see here in line item 3, is your average payroll subject to contribution. Okay, here on line B, these are the benefits that have been charged to your account. Okay, so there are 3 things fundamentally that we want to look at every tax rate notice, assuming that the state has been kind enough to provide them, which is a caveat I will offer, is that states across the country have decided that everyone's tax rate notice has to look totally different, and that they're going to organize the information on these tax rate notices totally different. Some folks, like the state of New York, will require that you go back in time and get the last 3 or 5 tax rate notices in order to ascertain what your benefits have been over the last few years. We'll look at some examples moving forward of states that provide all of that information. But fundamentally, what we're doing here is we're looking at this tax rate notice to get an idea of what we have paid in the form of a tax liability versus what the state has paid in the form of unemployment benefits. Okay, I'll say that again. What we're looking for is the difference between what the state has paid out on unemployment benefits on our behalf versus what we have paid the state in the form of a tax liability. Okay, back to that example earlier on in the session. If I have an organization, if my organization is paying the state $100,000 in the form of a tax liability, but I can ascertain that it's only $30,000 in unemployment benefits that are being paid out on my behalf, I'm getting the worst half of the deal, right? There's $70,000 on the table for me to potentially realize. This is from the state of Maryland, and I'm really grateful for the state of Maryland for providing this information because I think it's easy to understand, easy to access, and it's all right there for us, okay? You can see the tax rate notice right here. If you can follow my pointer. What's great about the state of Maryland also is that they're providing the last 3 years of unemployment benefits that have been paid, as well as, in this case, this is the average payroll that has been used to assess your tax liability. And in this case, I'm not sure that everyone can see it, unfortunately, but I like this tax rate notice particularly because it gives us some insight on what to look for in terms of viability. So in this portion right here, we can see incredible volatility from an unemployment benefit standpoint, okay? So in 2010, the unemployment benefits that were paid out by the state was $4,000. And in the subsequent 2 years, that sum jumped to $30,000. To my mind, that's a red flag, right? That kind of volatility does not support becoming a self-insurer. If your bill one year was $4,000 and the next year was 30 grand, right? That kind of volatility would be problematic. I think in this instance, especially when you do this math here on the side, you can see that we're paying the state about $27,000. We're paying the state about $27,000, and the last years the state is paying out on our behalf over 30, right? So we're getting the better half of the deal. I need to pick this up. This is the state of Pennsylvania. A great tax rate notice insofar as the state provides us all the information that we need for a taxpayer to ascertain whether or not there's an opportunity for us or not. Last slide. I just wanted to review some of the actionable tips that I've worked to present here today and that I think will be valuable at your organization. We want to examine your current program repeatedly and periodically. We want to look at what it is that your organization is paying in taxes versus what the state is paying in unemployment benefits, assuming that you're a taxpayer. Again, if you're a reimbursable employer, we want to examine if we have high reserves on ICE and what our liability is. We want to assess that also. We want to explore potentially going back to the tax, especially if we have those smaller subsidiary nonprofits, right? And we want to analyze the tax rate notices that we just looked at to determine if there is some opportunity there for us, either at our parent organization or at a merger. We want to assess our liability, absolutely. This is, again, calculating what our total potential unemployment costs might be. And finally, the steps that we can take to better manage unemployment during a merger and acquisition. Okay? It's lunchtime. Thank you all so much for your attention and patience. I hope you found that valuable.